السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
If you are struggling to become a profitable trader and find a trading setup that gives you an edge over the market, here in this video, we are going to share 3 of the best price action entries that helped us grow our small account when we first started trading. First, we will explain the key supply and demand zones for trading based on price action concepts. Second, we will present the best price action entry strategies we have found that make money in the Forex and stock markets. If that is something you are interested in, please give this video a thumbs up and subscribe if you are new. See you after the intro. So, what is the supply and demand zone? A supply zone is an area above, where the price failed to break through and was rejected multiple times. From the price action perspective, market sees this area as expensive, which causes buyers to close their long positions, and sellers to open their shorts. The outcome of this double action is what makes the price reverse from the supply area. Now in the opposite direction, a demand zone is an area below where price failed to break through and was rejected multiple times. From the price action view, the market sees this area as cheap, which causes sellers to close their short positions and buyers to open their longs. The outcome of this double action is what makes the price reverse from the demand area. Now let's discuss some of the key supply and demand areas on the chart that we consider optimal trading zones. The first key level is the turning points. Here on the Aussie dollar 4 hours time frame, the market was in a long-term downtrend until it reached this price, and the trend reversed. So these are our traditional resistance levels, but what is important for us is this turning point, which the market considers extremely cheap. That is why we identify this level as extreme demand, and if the price makes it to this level once again, it could provide a perfect trading opportunity. Here on the New Zealand dollar 1 hour time frame, the market was continuously shifting from an uptrend to a downtrend and vice versa. These minor swing levels in between the turning points are considered to be support and resistance areas. But the turning points are regarded as extreme supply and demand levels, which could provide the best trading opportunities since the market identified these levels as very cheap or expensive earlier. Next, we have major levels of the market structure. A major level of structure is a zone where 3 conditions are met. When a zone got rejected multiple times, acted as both support and resistance, and was recently respected, we call it a major level of structure, and it could produce some of the most accurate trading entries. Here on the pound-yen daily chart, this level got rejected multiple times, acted as both support and resistance, and recently was respected. Now when the price taps into this level, we expect the market to reject this price. See how many times the market reacted to this level along the way, and all we had to do was wait for an entry reason in lower time frame to open position, which we will discuss later in this video. Let's look at another example on Aussie dollar with the same concept. This trade has multiple conditions lining up. First, we have a major level of structure, so we expect the market to reject this price, also back of a bearish trend line which can signal a possible trend change, and a long wick candlestick strongly rejecting this area. So here is an important point. When multiple price action concepts meet in an area, it will be an optimal chance for high probability trading entries, since many traders focus on this area, and they will take action when trading opportunities arise. Next, we have higher time frame key levels. Many of the key levels you find on the lower time frames are invisible when you are using daily, weekly, or monthly time frames. But the visually obvious levels on the higher time frames are extremely important. Higher time frame key levels are very high quality, meaning that price often reacts to them, and a small reaction could be a major reversal in lower time frames. This is a monthly time frame, and these visible levels are your monthly areas. We don't trade on higher time frames, but here is a technique on how you can use them in your analysis. Label the closest levels in front of the price as monthly levels. Now, let's jump into the weekly. Here, adjust the monthly levels based on the weekly candles and also draw new weekly levels if it is obvious. Now, let's jump into the daily. Now once again, adjust the monthly and weekly levels based on daily candles. So, this technique allows you to see the bigger picture and notice the major levels of structure when you are trading in the lower time frames. For example, when price taps into these monthly levels, we know that these are not the ordinary supply and demand areas. They could be a reversal point for the short-term trends in lower time frames. Here is an important point. Keep your chart as simple as possible. If the higher time frame levels are obvious and help you with your overall analysis, draw them. But otherwise, let them be. Now that we have discussed market structure, key levels, and price action concepts, let me explain what setups we use to enter a trade. But before we continue, please hit the like and subscribe buttons if you have enjoyed this video so far. Also, let us know your thoughts and questions in the comment section, since we do our best to answer them all. So, we have two kinds of price action trading setups: trend continuation and reversal. Let's start with the trend continuation setups. The first setup is called the double top and double bottom rejection pattern. A double top or bottom is a popular M-shaped reversal pattern that price action traders are widely using. But keep in mind that we have two rules for a valid double top. First, the wick of the lower test at least hits the body of the higher one. And second, the body of the higher test does not exceed the wick of the lower one. The same thing is valid for a double bottom. This trading setup is a trend continuation strategy, so avoid using it when we have no obvious trending market. In the first step, we identify the direction of the trend. Then wait for the market to make a valid double top, if we are in an uptrend, or a valid double bottom, if we have a downtrend. Here in the Euro-Dollar 1 hour time frame, we can see that we are in an uptrend, and the market is making higher highs and higher lows, so we have a bullish bias. Then market made a double top and broke it to the upside. In the next step, we will draw a line at the close of the highest candle, wait for price to touch the line, and then look to execute our trade. For the entry, you could use multiple candlestick formations such as long wick rejection or bullish engulfing pattern. But we prefer to enter the trade when a candle closes above the highest point of the previous candle. Place your stop-loss 1 ATR below the lowest point of the rejection. The average true range, or ATR, is an indicator that measures market volatility. It gives you the average size of the previous 14 candles in default settings. So here, ATR is 12 pips. So we will place our stop 12 pips below the lowest point of the candle. For the first TP, you can make your trade break even by closing half of your position when the price reaches your 1 to 2 target. And for the second, you can target the next level of structure in front of the price. Here is an important point. It is important to check the higher timeframes to know how much room the price has to go until it reaches the next level of market structure. For example, if we had a monthly zone in front of the price, it could easily shift to a head and shoulders pattern and lead to a major trend change. Let's see another example. Here on the New Zealand dollar 30 minutes, we had a downtrend, and then the market made a double bottom and broke it to the downside. So first, we will draw a line on the close of the lowest candle of the double bottom pattern, and wait for the price to touch it. Then we will open a short position when the price prints a candle, closing below the lowest point of the previous one. Again, place your stop 1 ATR above the highest point of rejection, and target the next demand area. Now, let's move on to the next price action setup, which happens to be very simple but so powerful. This setup is based on the 786 Fibonacci retracement level, and it is best to use it on pairs with deep retracements, such as gold. This trading strategy is also a trend continuation setup, so use it when you can clearly identify the trend. Imagine we are in an uptrend, and market is continuously making higher highs and higher lows. The latest impulsive move starts from A and ends in B, and then the market makes a pullback. So here comes a question. Considering we are in an uptrend, what are the chances for price to retest the B before breaking the A and leading to a major trend change? The chances are pretty high. So, this is how we approach this market. We will put a Fibonacci retracement tool from A to B, and set a buying order precisely on the 786 level. Our stop will be couples of pips below the A, and we will target the B point. This way, your risk-to-reward ratio would be almost 1-to-3. Here on the gold 1-hour time frame, we had an obvious uptrend. We had a series of impulsive and corrective moves, and this is how we could apply the 786 Fibonacci retracement setup. Since our risk-to-reward ratio is 1-to-3, a winning trade can basically wash away 3 losing ones. Trend continuation trading setups have higher win rates, but if you want to make trades with a great risk-to-reward ratio, you have to trade reversals. So it'd be tricky. But here is a technique you could use to combine higher timeframe key levels with reversal patterns. For this trading setup, we use 2 timeframes. In the higher time frame, we want to identify a major level of structure. As we mentioned earlier, a major level of structure is a key level that has recently acted as both support and resistance multiple times. Here on the Euro-Dollar 4 hours time frame, we are in an uptrend, so we have bullish bias. Also, we can identify this major level of structure in front of the market. As the price moves towards this level, we know that this movement is a short-term downtrend in lower time frames, and we expect the price to reject this area. So we zoom into 1-hour time frame to observe the price behavior once it gets there, and possibly open a long position. Once price gets to our key zone, we only need a double bottom pattern to signal a possible trend change for the short-term uptrend. So, we will open our long position on the second test as market prints a bullish engulfing candlestick. Our stop will be 1 ATR below the lowest point of the swing low, and we will track our profit till we reach the next level of structure in the higher time frame. So let's have a quick recap of this reversal setup. First, we identified a major level of structure in front of the market on the higher time frame. We expect the market to reject this extreme demand area and possibly give us a buying opportunity. So we zoom into the lower time frame and look for a double bottom reversal pattern once the price gets there. The double bottom pattern shows that the market failed to create a new low, which indicates a loss of momentum. This signals that the short-term downtrend is over, and the market can potentially start to go to the upside. So, we will open our buying position and stop will be below the swing low. Keep in mind that these trading setups are not limited to any time frame or a pair, but please do your own backtesting and see which pair are most suitable for these strategies. So guys, that's it for this video.
السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.